Ladies and gentlemen, right now, almost everyone is looking the wrong way. They're chasing overvalued stocks, trusting a fragile dollar, and ignoring what's quietly setting up to be one of the biggest moves of this decade. Silver, yes, silver is being dismissed, underestimated, and mispriced. But history shows that when the crowd ignores real money, the correction isn't gradual, it's explosive. And what's coming next for silver in 2026 isn't just a rally. It's the kind of move most investors will only understand after it's too late. What you're being told about the economy right now simply doesn't hold up under scrutiny. The narrative of strength, resilient growth, controlled inflation, a soft landing, it all sounds reassuring, but it's built on a foundation that's far weaker than most people realize. The so-called strength isn't organic. It hasn't come from productivity gains, real savings, or sustainable investment. It's been manufactured through unprecedented levels of debt, artificial stimulus, and years of monetary policy that distorted the true cost of money. When interest rates were held near zero for so long, it sent a false signal to the entire economy. Borrowing looked cheap, risk looked manageable, and speculation looked like investment. Businesses took on debt not because they had productive opportunities, but because money was easy. Consumers spent not because their incomes justified it, but because credit was readily available. Governments expanded endlessly, assuming they could finance deficits without consequence. What we're seeing now is the delayed effect of all those distortions beginning to surface. The idea that inflation has been defeated is one of the biggest misconceptions out there. Inflation isn't just a number that moves up or down based on a narrow index. It's a monetary phenomenon, and the expansion of the money supply over the past several years has been enormous. Just because the rate of increase in consumer prices has slowed doesn't mean the problem has been solved. Prices are still significantly higher than they were, and the structural forces that push them up haven't disappeared. They've merely shifted, temporarily obscured by statistical interpretations and short-term fluctuations. Meanwhile, consumers are under far more pressure than the headlines suggest. Real wages haven't kept pace with the true cost of living. People are relying more on credit cards, dipping into savings, and stretching themselves just to maintain their standard of living. That's not a sign of strength, it's a sign of strain. An economy driven by consumption cannot remain healthy if that consumption is funded by debt rather than income. Eventually, something has to give. On the surface, the labor market is often presented as a pillar of strength, but even that deserves a closer look. Job growth figures don't tell the full story. The quality of jobs matters just as much as the quantity. A rise in part-time positions, multiple job holders, or lower-paying service jobs doesn't indicate a robust, thriving economy. It suggests that people are working harder just to stay in place. That's not progress. It's stagnation dressed up as resilience. Corporate performance also reflects this illusion. Many companies have reported strong earnings, but a significant portion of that has come from financial engineering rather than genuine growth. Stock buybacks, cost-cutting, and leveraging cheap debt have boosted earnings per share, creating the appearance of profitability. But those tactics don't create long-term value. They simply mask underlying weaknesses. When borrowing costs rise and demand softens, those same companies will find it much harder to maintain the illusion. The financial markets, too, have been conditioned to interpret any sign of weakness as a reason to expect more support. This has created a dangerous feedback loop where bad news is treated as good news because it might lead to policy intervention. But that mindset ignores the bigger picture. Continuous intervention doesn't solve problems. It delays them and often makes them worse. It encourages more risk-taking, more leverage, and more dependency on artificial support. What's particularly concerning is how much confidence is placed in the idea that policymakers can manage all of this without significant consequences. There's an assumption that they can fine-tune the economy, control inflation, sustain growth, and maintain stability all at the same time. History suggests otherwise. Economic cycles exist for a reason, and attempts to suppress them often lead to larger imbalances. The longer those imbalances are allowed to build, the more severe the eventual correction tends to be. You can already see early signs of stress in various parts of the economy. Certain sectors are slowing, defaults are beginning to rise, and the cost of servicing debt is increasing across the board. These aren't isolated issues. They're interconnected symptoms of a system that has been pushed beyond its natural limits. When money is no longer artificially cheap, the weaknesses that were hidden during the period of easy credit become impossible to ignore. The reality is that much of what's being described as economic strength is actually a byproduct of past stimulus rather than present stability. It's the after effect of policies that pulled demand forward, creating a temporary boost at the expense of future sustainability. That kind of growth isn't self-sustaining. It requires continuous support. And once that support becomes less effective or more costly, the cracks begin to widen. What makes this situation particularly challenging is that many people are still anchored to the narrative of resilience. They've been told repeatedly that the system is strong, that the worst is behind us, and that any problems are temporary. But economic reality doesn't bend to narratives. It responds to fundamentals. And the fundamentals, debt levels, monetary expansion, structural imbalances are pointing in a very different direction. As those realities become more apparent, the shift in perception can happen quickly. Confidence, once lost, is difficult to regain. And when the broader public begins to recognize that the strength they were promised isn't actually there, the adjustment won't be gradual. It will be abrupt because markets and economies tend to move from complacency to concern much faster than people expect. The confidence placed in the dollar today is not rooted in strength. It's rooted in habit. For decades, people have come to assume that it's the ultimate safe haven, the world's reserve currency, the foundation of global trade. But what most fail to recognize is that this status isn't permanent, and it isn't immune to the same economic forces that have brought down every other currency throughout history. The dollar is not an exception to the rules. It's simply been given more time before facing the consequences. What gives a currency real strength isn't political influence or military power. It's purchasing power, fiscal discipline, and trust. And those are precisely the areas where the foundation has been steadily eroding. The system has become dependent on deficits that grow larger year after year with no serious effort to rein them in. Spending continues to expand regardless of economic conditions, and the gap between revenue and expenditure is bridged not through productivity but through borrowing. That borrowing, in turn, has to be financed. And for a long time, it was relatively easy. Demand for dollar-denominated assets was strong, both domestically and internationally. But that demand wasn't driven purely by confidence. It was also driven by necessity and lack of alternatives. Now, that dynamic is beginning to shift. Other countries are starting to question whether holding large reserves in a currency backed by ever-increasing debt is a sustainable strategy. What makes the situation more fragile is the assumption that there will always be buyers willing to absorb that debt. But as the supply continues to grow, the willingness to hold it doesn't necessarily keep pace. When that imbalance widens, the only way to maintain demand is through higher yields or indirect monetization. And both of those come with consequences. Higher yields increase the cost of servicing the debt, putting even more pressure on fiscal stability. Monetization, on the other hand, undermines the currency itself by increasing its supply. This is where the illusion starts to break down. You can't continuously expand the supply of money without affecting its value. It may not show up immediately in exchange rates or consumer prices in a straight line, but the effect is cumulative. Over time, the purchasing power declines, and that decline is often masked by relative comparisons. If other currencies are also being mismanaged, the weakness may not be as obvious, but that doesn't mean it isn't there. Another factor that's often overlooked is how much of the dollar's strength is tied to confidence rather than fundamentals. As long as people believe in its stability, they're willing to hold it, transact in it, and store wealth in it. But confidence is not a permanent asset. It can change, and when it does, it tends to shift quickly. Once doubts begin to surface, the transition from trust to skepticism can accelerate far faster than most expect. You're already seeing early signs of diversification, bilateral trade agreements that bypass the dollar, central banks increasing their holdings of alternative assets, and a growing willingness to explore other settlement systems. These aren't isolated developments. They're part of a broader trend. It's not about an overnight collapse. It's about a gradual erosion of dominance that eventually reaches a tipping point. At the same time, domestic pressures are building. The cost of maintaining the current system is rising, and the margin for error is shrinking. Interest payments alone are becoming a larger portion of overall spending, which limits flexibility and increases vulnerability to changes in rates. The more resources that are diverted towards servicing existing obligations, the less capacity there is for productive investment. What complicates matters further is the reliance on policy responses that have worked in the past but may not be as effective going forward. Lowering rates, increasing liquidity, and expanding balance sheets can provide temporary relief, but they don't address the underlying issues. In fact, they often exacerbate them by encouraging even more borrowing and delaying necessary adjustments. The idea that all of this can continue indefinitely assumes that there are no limits, that demand will always be there, and that confidence will remain intact regardless of the fundamentals. But history suggests otherwise. Currencies don't fail gradually in a predictable, linear fashion. They reach a point where the imbalance becomes too large to ignore, and the adjustment that follows is often abrupt. What's particularly dangerous is how normalized the current trajectory has become. Large deficits, expanding debt, and aggressive monetary policies are no longer viewed as extraordinary. They're seen as standard practice. That normalization reduces the sense of urgency and makes it easier to dismiss the risks. But ignoring a problem doesn't eliminate it. It simply allows it to grow. The longer this continues, the more dependent the system becomes on maintaining the status quo. And the more dependent it becomes, the more disruptive any change will be. That's why the concept of borrowed time is so important. It's not about predicting an exact moment when everything shifts. It's about recognizing that the current path is not sustainable and that the stability being observed is conditional, not permanent. When the adjustment finally comes, it won't be framed as a gradual policy shift. It will be recognized as a loss of purchasing power, a repricing of assets, and a reassessment of what constitutes real value. And by that point, the narrative will have already changed. The confidence that once supported the system will have diminished, and the realization will set in that what appeared stable was in fact far more fragile than it seemed. There's a fundamental disconnect in how the market is currently valuing silver relative to gold, and it's not a small one. It's historically significant. When you step back and look at the long-term relationship between these two metals, what stands out immediately is how far silver has drifted from its historical norm. This isn't just a minor pricing inefficiency. It's the kind of imbalance that tends to correct in a very aggressive and often unexpected way. For centuries, gold and silver moved in a relatively stable ratio. Markets left to function without heavy distortion tended to price silver at a fraction of gold that reflected both its relative scarcity and its dual role as money and a commodity. That ratio wasn't fixed, but it generally stayed within a range that made sense based on supply, demand, and monetary use. What we're seeing now is a ratio that has stretched far beyond those historical boundaries, and that kind of divergence rarely persists indefinitely. The key point here is that silver hasn't become less valuable in any fundamental sense. It hasn't lost its monetary properties. It hasn't become obsolete. In fact, its industrial importance has arguably increased. What has changed is the way it's being perceived and priced in the market. Gold continues to receive the bulk of attention as a store of value, particularly during times of uncertainty, while silver is often treated as an afterthought, too volatile, too industrial, or simply too small to matter. That perception is precisely what creates the opportunity. When markets misprice assets, they don't do so forever. Eventually, reality reasserts itself. And in the case of silver, the reversion process is typically not subtle. Historically, when the gold to silver ratio becomes excessively stretched, the correction tends to come through a combination of gold rising and silver rising faster. That's the key distinction. Silver doesn't just follow gold, it tends to outperform it significantly during periods of monetary realignment. Part of the reason for this lies in the size and structure of the market. The silver market is much smaller and less liquid than gold. That means it takes less capital to move prices, and when investor demand begins to shift, the impact can be amplified. What looks like a stable, overlooked market can quickly turn into one characterized by sharp, rapid price movements. That's not speculation. That's a function of supply and demand dynamics in a relatively constrained market. Another factor is how silver is positioned in the minds of investors. Because it's often seen as secondary to gold, it tends to be underowned during the early stages of a cycle. Investors allocate to gold first, viewing it as the primary hedge. But once the trend becomes established and confidence in precious metals grows, attention shifts. That's when silver begins to attract more interest, not just from institutional players, but from retail investors as well. And because the starting point is typically one of underinvestment, the inflow of capital has a disproportionate effect. What's particularly interesting about the current environment is that the conditions that have historically driven these revaluations are already in place. Monetary expansion, currency concerns, and growing skepticism about traditional financial assets are all factors that tend to benefit precious metals. Yet, despite this backdrop, silver remains priced as though those forces are either temporary or irrelevant. That disconnect is what makes the current situation so compelling. It's also worth considering the supply side of the equation. Silver production is not as flexible as many assume. A significant portion of silver is produced as a byproduct of mining for other metals. That means supply doesn't necessarily respond quickly to changes in price. Even if prices rise, it doesn't immediately lead to a surge in production. This creates a lag that can exacerbate price movements when demand increases. In other words, when the market tightens, it can tighten quickly. At the same time, above-ground inventories are not as abundant as they once were. Over the years, much of the easily accessible silver has been consumed in industrial applications. Unlike gold, which is largely held and recycled, a substantial amount of silver is used in ways that make recovery uneconomical. This gradual depletion adds another layer of constraint to the market, one that isn't always fully appreciated in pricing. The combination of these factors, historical undervaluation, structural market characteristics, and supply constraints, creates a setup that doesn't require extreme assumptions to justify higher prices. It simply requires a return to more balanced conditions. And when that process begins, it tends to feed on itself. Rising prices attract attention. Attention brings in more capital, and that capital drives prices higher still. What makes this particularly significant is the timing. The longer the ratio remains stretched, the more pressure builds for a correction. It's similar to a coiled spring. The further it's compressed, the more forceful the release. Markets don't operate on precise schedules, but they do respond to imbalances. And when those imbalances reach a certain point, the adjustment can be both rapid and dramatic. Right now, silver is being priced as though it doesn't fully share in the monetary characteristics that have historically defined it. It's being treated as if its role is primarily industrial, secondary, and optional, but that interpretation overlooks a long history of silver functioning as money, as a store of value, and as a critical component of financial systems. Those characteristics don't disappear, become more relevant when confidence in other forms of money begins to waver. When that shift in perception takes hold, the revaluation won't be driven by speculation alone. It will be driven by a reassessment of what silver actually represents, and that reassessment, once underway, has the potential to close the gap between where silver is now and where historical relationships suggest it should be. What makes silver uniquely positioned right now isn't just one factor. It's the collision of two powerful forces that rarely align at this scale. On one side, you have accelerating industrial demand driven by modern technology and global infrastructure shifts. On the other, you have the reemergence of monetary demand as confidence in paper assets begins to erode. Each of these forces on its own would be enough to support higher prices. Together, they create a setup that is far more explosive than most investors are prepared for. Silver is not just another commodity that rises and falls with economic cycles. It occupies a dual role that very few assets can claim. It's both a critical industrial input and a form of real money. That combination means it responds to entirely different drivers at the same time. When the economy expands, industrial demand increases. When confidence in the financial system weakens, monetary demand increases. Under normal conditions, these forces might offset each other. But what happens when they start moving in the same direction? On the industrial side, the demand story is not hypothetical. It's already happening. Silver is an essential component in a wide range of technologies that are central to the modern economy, from solar energy systems to electric vehicles. From advanced electronics to medical applications, silver's unique properties make it difficult to substitute. It's not just useful, it's often necessary. As global demand for these technologies grows, so does the baseline demand for silver. Regardless of price, what's important to understand is that industrial users of silver are not particularly sensitive to price in the way investors are. If a manufacturer needs silver to produce a product, they're going to buy it. The cost of the silver is often a small fraction of the total value of the finished product. That means even significant increases in the price of silver don't necessarily lead to a reduction in demand. Instead, they get absorbed into the overall cost structure. This creates a kind of inelastic demand that can persist even as prices rise. At the same time, supply is not keeping pace with this growing demand. Mining output is constrained by a number of factors, including declining ore grades, environmental regulations, and the fact that much of the silver supply comes as a byproduct of mining other metals. This limits the ability of producers to respond quickly to higher prices. You can't just flip a switch and increase production. There are long lead times, significant capital requirements, and structural limitations that prevent rapid expansion. Now layer on top of that the monetary side of the equation. As confidence in fiat currencies begins to weaken, investors start looking for alternatives, assets that can preserve value in an environment where purchasing power is being eroded. Historically, that's where precious metals come in. Gold tends to lead this movement, but silver follows and often accelerates it because silver is more affordable and more accessible. It attracts a broader base of investors once the trend becomes clear. What makes this particularly powerful is the shift in perception that accompanies it. Silver goes from being seen as just another commodity to being recognized as a store of value. That change doesn't happen gradually. It tends to happen in waves. At first, it's driven by a small group of investors who understand the underlying dynamics. Then it spreads as rising prices attract attention and validate the thesis. Eventually, it becomes a broader movement, pulling in capital from all directions. The problem is that the market is not prepared for both of these demand streams to intensify simultaneously. It's one thing to have strong industrial demand in a stable monetary environment. It's another to have rising investment demand in a weak industrial cycle. But when both are increasing at the same time, the pressure on supply becomes much more intense. There's no easy release valve. Inventories get drawn down, premiums rise, and the price has to adjust to balance the market. This is where the concept of a perfect storm becomes more than just a metaphor. It's a description of what happens when multiple reinforcing factors converge in a system that lacks flexibility. The silver market doesn't have the depth or elasticity to absorb large, sustained increases in demand without significant price movement. And because it's relatively small compared to other asset markets, even modest shifts in capital allocation can have an outsized impact. Another aspect that often gets overlooked is how quickly sentiment can change once momentum builds. For a long time, silver can remain under the radar, dismissed or ignored. But once it starts moving, that perception shifts. What was once seen as uninteresting suddenly becomes attractive. Investors who previously overlooked it begin to reconsider. Those who were waiting for confirmation jump in, and those who missed the early stages start chasing the move. At that point, the dynamics become self-reinforcing. Higher prices attract more buyers, which pushes prices higher still. Meanwhile, the underlying drivers, industrial demand and monetary demand, continue to operate in the background, providing fundamental support. This isn't a short-term spike driven purely by speculation. It's a structural shift that reflects a deeper imbalance between supply and demand. What makes this scenario particularly compelling is that it doesn't rely on extreme assumptions. It doesn't require a collapse of the financial systems or a sudden surge in industrial activity. It simply requires the continuation of trends that are already in place. Gradual increases in demand, combined with constrained supply and a shift in investor behavior, are enough to create significant upward pressure over time. And yet, despite all of this, the market is still pricing silver as though these forces are either temporary or insignificant. That's the disconnect. The conditions for a major move are not only present, they're building. And because the adjustment mechanism in this market is primarily price, the resolution of that imbalance is unlikely to be subtle. It's far more likely to be sharp, fast, and difficult to ignore once it begins.